I'll go back to where people were talking about $150 oil
Mm-hmm.
and where we are now, even with the little bit of a rally we've had, we call it $80 in TI. And the cracks, I think today they hit $90. So, I mean, if you
It
look at what
settled over.
the wholesale product market is, it's over that 150 number. You're definitely in demand destruction territory. It's spectacular to see cracks higher than the outright
Yeah.
crude price. I'll go back to where people were talking about $150 oil
Mm-hmm.
and where we are now, even with the little bit of a rally we've had, we call it $80 in TI. And the cracks, I think today they hit $90. So, I mean, if you
It
look at what
settled over.
the wholesale product market is, it's over that 150 number. You're definitely in demand destruction territory. It's spectacular to see cracks higher than the outright
Yeah.
crude price.
Welcome to the Energy Desk, a podcast from Mobius Risk Group. In this series, we break down the macro forces and fundamental trends shaping global energy markets. We cover everything from geopolitics and policy to supply, demand, and the price risks that we're watching behind the scenes. Each episode is designed to cut through the noise and give you clear, actual insight into what's driving today's energy landscape and what it means for what comes next. You can follow the show wherever you get your podcasts. You can share feedback or ask questions by emailing podcast@mobiusriskgroup.com. Let's get started. All right, we are back on the Energy Desk, sitting here July 16th, just before 5 p.m. Central. Mohit, how's it going?
How are you doing?
Living large. Lots of activity going on in the world and plenty of things to keep an eye on.
Particularly for energy markets, right?
Yeah, exactly. Nonstop. So maybe, we'll be surprised in the next couple of weeks, months, who knows how long, and have a different primary driver happening either in crude or natural gas. But
For now,
yeah,
it's all Middle East.
for now, that's where we are. And so, yeah, we were here just about 2 weeks ago, and we had the kind of peak pendulum swing from the highest point or most escalated point of the U.S.-Iran conflict in the March to kind of late May period. And then we were sitting there at the end of last month, and it swung all the way back the other direction. We talked about that pendulum swing. And 2 weeks later, the pendulum has at least partially made its way back the other way.
Yeah.
We'll see what the movement looks like going forward. But a few things to discuss on the crude side, just some kind of quick, kind of important drivers or developments that have come out. And I think if you want to start maybe on a high level and just kind of recap what happened in the last 2 weeks to basically bring us back to kind of the conflict premium type of level.
Yeah, just to continue from where you left it. Okay, so we went from peak kinetic activity to people saying, okay, there's a deal imminent, and then you had prices pretty much retrace the entire move. And I know you and I have been talking about it. It's really the spec selling, which was spectacular. Is it like 375,000 contracts in
just
about
about
8-9 weeks? Yeah.
Yeah.
So we went from pre-conflict being max short to almost top decile long, and then back to being max short right before it was too fast, too quickly.
Yeah.
And now here we are. I think you're starting to see some of that short covering happening. It was surprising to me to see how not just the pricing, but even the curve shape. We went 3-4 months into contango right before things started getting hot again.
Yeah, as the kind of prices came back, it was interesting because it was basically, we hit just below or just about the February 28th prompt. And then it was something like 2 days, 3 days after that, you start to get some attacks on vessels. And then through the weekend, you then get the U.S. Strikes on Iran starting again.
And going back on the conflict, I mean, you go from the attacks on the ships to saying, okay, ceasefire is kind of over, to now we are at full blockade and ongoing strikes pretty much every day.
Yeah, so I'll just kind of cover where we are today on Thursday, as I said, July 16th. So blockade, as you mentioned, is back in effect. Sanctions were reinstated by OFAC. And then the CENTCOM today said that U.S. forces were beginning their sixth consecutive night of strikes across Iran as of 2 p.m. Eastern. The U.S. side of that, and then the Iranian response to this kind of increase. They already were attacking the vessels, have continued attacking certain vessels, and as well as just drone and missile launches basically across the entire Gulf region. That's been obviously renewed hostilities there, but the other factor that's been isolated so far, but definitely one to watch, is the Houthi activity.
Yeah.
So in Yemen, there was some strikes on one of the airports in Houthi-controlled Yemen, and that was claimed by the official or the recognized government of Yemen, but the Houthis responded by launching, I believe it was 6 missiles at Saudi Arabia. Limited impact, nothing really since then other than kind of this escalatory rhetoric from both Iran and the Houthi leadership. So just one to watch there, because then obviously the next waterway that would be in jeopardy would be the Red Sea, al-Mandeb Strait, and then there's the kind of glaring question of would they target the east-west pipeline that is Saudi Arabia's primary Gulf bypass. So that'll be just kind of one of the additional factors lurking in the background. And then outside of the Middle East, one thing that I think is good for us to cover is it's been a big driver for products, for diesel especially, is the Russian diesel export ban. So there was murmurings about that potentially being imposed earlier in kind of June as a result of Ukraine's just consistent attacks on their energy infrastructure, primarily targeting refineries through that kind of April to June period. And we got that diesel export ban announced through the end of July at a minimum. And most likely, I would anticipate that gets extended, similar to what we saw for their gasoline and jet bans, export bans, through November. So we'll see what that looks like. But I think that's maybe a good opportunity for you to hop in on some of the product side, because that's been pretty wild.
That has been wild. I mean, I'll go back to where people were talking about $150 oil, and where we are now, even with the little bit of a rally we've had, we call it $80 in TI, and the cracks, I think today they hit almost $90. So I mean, if you look at what the wholesale product market is, it's well over that 150 number, and so you're definitely in demand destruction territory.
Yeah,
but it's spectacular to see cracks higher than the outright crude price.
Yeah. No, it's been amazing to watch. And we had a little bit of a pullback yesterday following the DOE report, which showed a pretty bearish seasonal build in U.S. distillate inventories. You had exports come off a little bit, and you had implied demand fall off pretty aggressively. So there was a little bit of a cautionary pullback yesterday, but recovered from that today. And as you mentioned, we settled over $90 for the prompt diesel crack, and gasoline's been rich too.
Yeah, gasoline's at about $60. So yeah, refiners, I was talking to one earlier today, they're just loving life. But it's interesting to see where things are, and we talked about that on the call earlier. Is okay, crude supply can come back faster, but at the end of the day, you need refining capacity.
Yeah,
and it's not product barrels which are being held back. So as the crude price had come off, I mean, cracks were staying elevated. And here we are with continued Ukrainian attacks. And then we're getting back into this territory of potential crude supply issues, and cracks are just screaming.
Yeah. And that's been, an interesting, I guess there's kind of the contradictions in some ways, or competing pressures on different sides. But for crude prices, as we look at natural gas, that's been one that's been definitely an interesting driver as well, because when you look at the obvious disruption risk for crude and refined products with the Strait of Hormuz. You also have one of the largest LNG exporters that has been affected, Qatar. So the Qatari LNG supplies they announced in the second half of June, following one of their carriers getting hit by an Iranian drone. They announced that they're halting their restart plans for Ras Laffan, and that one still is a little bit of a TBD. But as we get closer and closer to winter, that's going to be definitely a factor that gets reflected in the market. And we saw that get reflected in the market for the pull with European storage levels being so low. That's just an increasingly relevant risk to on the international market for kind of pull on domestic supplies. So, you were talking a little bit about the winter versus front of the curve reaction. I don't know if you want to touch on that here.
Yeah, on the crude side, as prices came off, you had support on the gas side because it was okay. All the associated gas is potentially not going to come on, and then we've seen 9 days of crude rally, and you've seen 8 days of gas pullback, at least in the front, and they're kind of going hand in hand. Where you do see a different behavior is in the 1Q because, as you're saying, as supply becomes an issue and crude rallies because of that, and you get the Qatari gas potentially being an issue, and same with refill in Europe, starting to see that premium again get repriced in 1Q. And that is consistent with where you would expect to see it. That's where the real demand, real competing for molecules is going to happen. And I was also looking at the TTF chart coming in here. It's interesting. It's again gone almost 2/3 of the way to the peak, which we saw in March, April. So that's kind of been a really rapid rise over the last 10, 12 trading sessions. So
yeah. And as we get closer and closer to kind of the typical fall end of season mark, that's going to be definitely a risk factor for Europe. Not really a whole lot of options for them. But on the flip side, digging more into the gas, what's been going on in the natural gas market, for the international stuff that we've covered, there's also some competing themes with weather and storage. So we've maintained a storage surplus. Today's report was in line with expectations, but brought us to essentially the 64th percentile of the trailing 10-year seasonal distribution for lower 48 working gas. So we're sitting just over 3 TCF. We're a little bit below last year, but we're elevated versus seasonal norms. And the outlook for that has been affected, obviously, by a few different factors. We've touched on the associated gas expectations getting revised back higher to kind of where they were in peak conflict time. But you have also short-term weather factors. You have second half of July and early August starting to look like it's going to be closer to normal weather for this time of year, maybe slightly cooler than normal. So losing some of that CDD surplus that we had towards the end of June and start of July. And then long-range weather has been a bigger factor as well, with El Nino being confirmed. We discussed that, I believe, or hinted at that in some of our prior conversations. But El Nino, the most recent update from the NOAA, still have that advisory in place. So we are in El Nino, and it has strengthened. And the new outlook says that they are expecting an 81% chance of a very strong El Nino arriving sometime between October and December, and would be potentially the largest El Nino event in the history of their data back to 1950. So with that, though, there is the caveat. Strong El Nino does not necessarily mean strong event or strong impacts, rather. But typically what that means for the lower 48 is you're going to have pretty material warmth or anomalous warmth for the winter season in most of the lower 48. So the only kind of exception to that is going to be South Central a little bit, and current long-range forecasts show potentially cooler in South Central and Southeast. So that's going to be a big one, because as you see storage hang on to that surplus, the current trend and domestic storage is putting us pretty close to top decile, potentially even 95th percentile or higher levels for our fall end of season balance. So it's definitely going to be an interesting one. And then if you have all of that Permian gas, associated gas coming in too, just going to be a pretty heavy weight for Henry Hub. So do you have any thoughts on the NYMEX side for gas?
Yeah, I think that's something to really watch as we are in the peak heat. But you've also got a lot of renewables which are impacting the gas demand. Once peak heat is gone, that's really when event risk starts increasing. So let's flip from watching the probability for soccer and move to hurricane starts. And that's where we really need to watch for what happens, because it's going to be a demand impact on LNG exports. So
Yeah.
that's going to be something to watch for sure.
Yeah. Yeah, and on the hurricane side, important to mention that typically El Nino reduces hurricane risk. And at the start of the season, the forecast was for a below average hurricane season. So there is potentially some alleviating, fewer risks of a hurricane related disruption to LNG offtake. But considering where supply is still relatively strong, any interruption to a now sizable chunk of domestic demand coming from LNG, that's going to be a pretty significant impact. On the LNG side, we did have some factors at play there as well, increasing expectations for our fall end of season balance. So Freeport announced a major maintenance through late August, and that could be a demand impact of roughly half a BCF to 1.5 BCF a day, potentially a little bit more through basically the peak cooling season. So you're going to have a little bit of an impact there. We've seen that reflected. So definitely have plenty of downside drivers at play. On the flip side, that, as we've seen with crude, creates potential room for massive short covering, and we've seen shorts in gas get pretty elevated as well.
Yeah, I was going to say that's one of the drivers which has been happening, is everything is lining up for the bears, so the shorts have been piling in.
Yeah.
And if everything doesn't go according to plan, then you do have that short covering risk.
Yeah. So I think there's no shortage of things that are going to be happening, even between both crude and natural gas for the next little bit. Crude definitely seems to be the faster moving of the two for the time being.
Yeah. And one thing on the gas side, I'd say, even if it is, warmer, we always used to say this, as long as you get cold in 2 parts of the world out of 3, so think of North America, Europe, Asia, gas demand becomes really, really strong. And given Europe is low, Asia is scrambling for molecules, we could still see some fireworks in the winter. They could be short-lived, but they could be violent.
Yeah, it's a great point. Well, I think that is a perfect overview, and maybe it gives us some opportunities to dig into a few more things as more developments happen, which they definitely will over the next little bit.
Shortage of that.
Yeah, no doubt. All right. Well, with that, I think that's good. So I'll see you next time, and it's good chatting with you as always.
Yeah, likewise.
Thanks for joining us on the Energy Desk. Please keep in mind this commentary contains our views and opinions and is based on information from sources we believe are reliable. This commentary is for informational purposes, should not be considered investment advice, and is not intended as an offer or solicitation with respect to the purchase and sale of commodity interests, or to serve as the basis for one to decide to execute derivatives or other transactions. This commentary is not considered promotional material.